Alright everyone, Cowboy Trades here, welcome back to the channel for a quick update on the SP 500. This video is going to be focused on the higher time frames. There's a few charts that I want to update. We've got two charts over here talking about a throwover pattern. I also do want to update this Elliott wave theory wave count for the SP 500. And also a lot of people have been asking me, what are my up-to-date thoughts on the SP 500 2008 fractal, and we'll also be looking at the SP 500 2000 fractal. Now, let's start off on these throwover patterns. Starting off with this chart over here. Now, I would like to highlight, depending on which chart you're looking at for the SPX, some of these charts have not quite come back down and broken beneath the trend line. But if we are looking at the SPX chart listed over on Blackball, you can actually see that we have broken back beneath the trend. On the weekly time frame, yesterday we actually had a daily candle body close, and today it looks like we're putting in a doji candle signaling indecision for the markets. Now, this is the higher time frames. I don't want to spend too much time on the lower time frames, but you can also see, like we discussed on the channel quite recently, the SPX has been putting in a bump and run pattern, and we are heading right back down to this trend line. So around about 3,990 is a very, very crucial level for the S&P 500 right now. This is really all I wanted to mention in the lower time frames, but the reason why I wanted to mention this in the lower time frames, as you can see over here, 3,990 is also in confluence, pretty much right on par with this. This is actually sitting at 4,000, but we've got a lot of very important supports sitting at this 3,990 level, or 4,000 depending on which one you want to look at. But this level is extremely crucial, and for this chart we are breaking to the downside of this. Now, kind of ignore these white or slightly blue hueish bars that I have indicated on the screen. These correlate to insiders selling in the equity markets, and we have made a specific video on this over here. Insiders are selling their stocks and what this means for the market. So if you want to learn more about that, check that out. I won't focus on that in this video. But for this chart, we have had a throwover, or at least it's looking like this is going to be a throwover, and we are going to break back down, and this could be one of the largest throwovers we've seen in S&P 500 history. And if we do also come back over to update this Elliott wave count, like we previously discussed, this asymmetrical triangle is a bearish continuation pattern. Now, these happen in bear markets, and these also happen in bull markets. So for example, if we invert the scale, something like a bullish 1, 2, 3, 4, 5 wave count, followed by a B, C, D, E asymmetrical triangle, are normally signs in a bull market that you're going to get continuation to the upside, and it's the inverse of that in a bear market. So this is how it looks in a bear market, which we obviously are in. It's really not arguable. You've got a bearish 1, 2, 3, 4, 5 wave count, followed up by an asymmetrical 5 wave triangle, A, B, C, D, E. Now, like we said, we have had one of the biggest throwovers in S&P 500 history, and also the markets are moving very, very degeneratively, which is, making me believe that while this Elliott wave count, from a which is making me believe that, while technically this Elliott wave count is not 100% valid anymore, because if we do come over to the daily time frame, you can see that wave E has actually now exceeded wave C. There's a few different ways that you could still argue this is in play. For example, if you come over to the monthly time frame, wave E actually put in a monthly candle body close beneath wave C, so it's not 100% done and dusted. And also, like we discussed in this video for the insider transaction ratio, we had a lot of stocks doing, historical degeneracy, where you've got, stocks missing their earnings per share, and they rallied, which has never happened before in the equity markets. So we're seeing a lot of degeneracy in the markets right now, which has obviously led us to have this fake out outside of, this bearish market structure. And also for the S&P 500, like I would like to highlight, you are sitting right here. We're seeing the same price target show up again, 3,990. This level is extremely crucial. So I will keep you up to date on how this Elliott wave theory plans out. Like I said, it doesn't look the nicest right now, but if this does end up breaking us down to the downside of this asymmetrical triangle, this Elliott wave count is going to be perfectly valid, and you're going to see this as more of just a huge throwover before the next move to the downside. But like we discussed in the lower time frame chart here, 3,990 shows itself. As we looked over here, the price target of 4,000 is the price target you need to keep your eyes on for this throwover. If we come over to a different S&P 500 chart where we are still, you know, kind of holding this level. What you can see is round about 3,980 is also another target to keep your eyes on. But really, you know, a lot of these supports are hinging on the 3,990 level. And if you start seeing the SPX break beneath this level, it's going to be pretty much curtains. So like I said, I'll keep you up to date on this. Now, if we do come back over to our S&P 500 fractals, let's look at what's happening in the 2008 fractal. Now, on the channel, I always told you that I was going to keep this in mind, and I was going to keep on updating you on this chart. And we did say at some point in time this is going to diverge, but we will use this chart to track how the markets are moving until we do finally get that divergence. Now, while for 1, 2, 3, 4, 5 weeks or so, well, I say 5 weeks, but you can see this was meant to be breaking down, and we were meant to have a rally on this data point. So, you know, we were meant to break down very hard, so we diverged for a few weeks, but we did actually have a rally back over here, and it seems like the top in this market cycle happening in 2023 beautifully lined up with the top over here. So, you know, according to this fractal, like I said, I mean, the reason why we look at the 2008 fractal is not to say, hey, we 100% have to follow what happened in 2008. Obviously, every single cycle is going to be different, but when you are looking at what happened in 2000, there are similarities. When you are looking at 2008, there are similarities. And when we are looking at this, you know, this is kind of predicting that we should be once again having a monumental slide to the downside. The 2008 fractal was actually predicting a rally up until April, but nonetheless, looking at the 2008 ebbs and flows in general, you know, we should be moving down, you know, a lot further before we do have another bounce for the market. So I will keep you up to date on this. I don't think that we can count the 2008 fractal out so far. Obviously, we've retroactively fit the top, but this has diverged a few times, and it's very accurately called a lot of data points in the market. So this one little divergence over here is not too much to worry about, but I do think, you know, the general trajectory following this 2008 fractal is still going to be in play. If we come over to the 2000 fractal, what's interesting is what happened in the year of 2000 during the .com crash. As you can see, this low over here was actually much more accurately called on the 2000 chart. You can see this rally was beautifully called, and it does seem like we have topped out prior to where we would have in 2000. Like we've said, no bear market is going to be 100% the same. We kind of just look at these to say, hey, are we still following the general trajectory of what happened in 2008? And yes, I do believe we are. Are we following, you know, once again, if we draw like a moving average through what happened in the year of 2000, are we following, you know, this general moving average for the price action? Yes, I do believe we are. If we draw a, you know, once again, drawing something like a moving average through the data points, are we still following the general ebbs and flows of what happened in 2008? Yes, I do believe we are at this moment in time. So coming back over to the year of 2000, this is predicting that we should be breaking down and kind of coming down into new lows in July. Now, what's interesting about this perceived bottom in the year 2000 round about July time is we quite recently made a video, FOMC minutes meeting this week, everything you need to know. And when we looked at the meeting probabilities of where the interest rates were kind of looking to top out, round about 5.5%, the markets believed that this was most likely to happen in June or July. And once again, coming back over to this chart, it's looking like July, the start of July, so pretty much right between these two data points is where the S&P 500 2000 fractal is predicting that we're going to have a local bottom, which would line up with the interest rate. So potentially interest rates could start getting paused round about this time, the markets could have a rally, and as we've previously discussed on this channel, most of the pain is seen in the markets after the Fed pauses the interest rates, and then once the interest rates start to lower, contrary to popular belief, this is actually when the markets have their final leg to the downside, not when the bear market lows have formed. So like I said, just wanted to give you an update, really focused on the higher time frames. If you're going to take away anything from this video, it is the fact that we really need to keep our eyes on how 3,990 pans out. If we do start breaking beneath this support level for the S&P 500, then this is going to look like one big throwover pattern, and we're very, very likely to start absolutely nuking to the downside and making new lows coming into June and July. So for today, my friends, that's all I've got. As always, if you do enjoy the content, let me know down below by leaving a like and a comment, share the videos with your friends, and if you do want more of my post charts, memes, economic data, all that good stuff, be sure to head over to my Twitter at 618_cowboy. Come and join the Discord. If you do, head over to my YouTube, click on the About section. You can see all of my official links are down below for Twitter, Discord, Instagram, and my merch store. But for today, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.